Bismillahirrahmanirrahim. Assalamu alaikum. Welcome to Mastering Accounting Skills. Today our topic is basic accounting concepts. Actually, I was receiving a lot of messages in my inbox to have a complete one-on-one practical training from scratch to the end. That's why instead of adding videos on random topics, I have decided to start video lectures in sequence for accountants practical training. This is my second video for this series. In our previous video, we have discussed chart of accounts. Now we will learn basic accounting concepts which are commonly used in accounting profession, and also it is very important for accountants to be clear on these concepts. The topics we will discuss in this video are accounting basics, accounting equation, 3 stages of accounting, accrual basis of accounting, and finally the accounting cycle. First of all, we will discuss accounting basics. In accounting basics, we will see first the account types. This we have previously discussed also in chart of accounts. Being an important part of basic accounting concepts, we will have a little introduction of account types once again. So we have 5 types of account in our chart of account. One is assets, liabilities, capital, revenue, and expense. Assets, liabilities, and capital, these are reported in balance sheet, and revenue and expense, both of these relates to the income statement. Then double entry accounting system. In double entry accounting system, each transaction has 2 effects. One is debit and the other is credit. There may be multiple accounts or at least 2 accounts involved in each transaction, but the total of debit and credit will always be equal. This entry is commonly known as general voucher. This is the base of an accounting system. All the reports generated from accounting system will depend upon this general voucher. Whatever purchase, sales, receipt or payment forms you are using to record a transaction in any accounting system, at the background in database, all accounting systems are passing this general voucher for each transaction. Then next is effects of debit and credit. What will be the effect of debit and credit on each type of account? So for the assets, if there is an increase, like you are receiving cash, so cash is an asset, so you will give debit to the cash. And to decrease in asset, if you are making a payment from the cash, then you will give credit to the cash. So this is the main concept of debit and credit for assets. And for liabilities, if there is a decrease, you will give debit, and if there is a increase, for increase it will be credit. Capital also same as liabilities. For the decrease in capital, you will give debit to the capital, and for increase in capital, you will give credit. Revenue is also same as capital and liabilities. If there is a decrease, you have a sales return, then you will give debit to the sales. And if there is an increase, so revenue, to increase the revenue, you will give credit to the revenue account head. For the expenses, increase will be from debit and decrease will comes from credit. Okay, so as you can see, assets and expense, for the increase we will give them debit, and for any decrease we will make it credit. And for liabilities, capital and revenue, these have same effect. For the debit it will decrease, and for the credit it will increase. Now we will discuss the accounting equation. Why the debit and credit should be equal? As in under double entry accounting system, you have seen that debit and credit of each transaction must be equal. This is the main principle of accounting. Due to this principle, accounting equation comes true. Accounting equation tells us that a company's total assets are always equal to its liabilities plus equity. It captures the relationship between real accounts, that is assets, liabilities, and the equity. While reading the accounting equation, a question may arise in your mind: why there is no role of income and expense accounts in accounting equation? as these are also part of accounting? This question may be answered by following equation. Assets is equal to liabilities plus equity plus profit or retained earnings. Or you can further elaborate accounting equation as assets is equal to liabilities plus equity plus revenue minus expenses. After year-end closing, profit will become part of equity because retained earning is always added to the equity in balance sheet. That's why the final result will be the accounting equation in short form. Assets is equal to liabilities plus equity. So this will be the final accounting equation. What are three stages of accounting? Vouching stage, processing stage, and the reporting stage. So these are the three things what in our accounting system. First of all, we will vouch a transaction, then system will process that transaction. It will post the debits and credit for each account heads to the particular general ledger, and from general ledger we will go and generate the report. So these are the three stages of accounting: vouching stage, processing stage, and reporting stage. The next, accrual basis of accounting. This accounting principle is commonly followed by both accounting standards, GAAP and IFRS. Both are following this standard. This principle of accounting recognizes the expense when it is incurred, not when it is paid, and records the revenue when it is actually earned, not on the receipt of payment from customer. Any expense paid as advance is recorded as prepaid expense under current assets. It will not go to the income statement directly until it will spent out. Any income received in advance is recorded as unearned revenue under current liabilities. The last thing we will discuss in this video is the accounting cycle. The accounting cycle is a comprehensive chart that describes all the processes and their sequence in an accounting system from starting point to the ending point. So in accounting system, the first step is the journal entries. So first of all, when any transaction happen, you will go and you will pass the journal entry. Okay, one account you will give debit and the other credit. So you will pass this entry. This entry, then it will transfer all the debits and credits to the particular ledger accounts. Okay, suppose we have purchased a furniture and we pass the journal entry, purchase the furniture on cash. Then we will give debit to the furniture, our asset will increase, and we will give credit to the cash. So this credit and debit for furniture and cash, it will transfer to the ledger accounts. From the ledger accounts, when all the transactions are posted, then this ledger accounts balances, it will go to the unadjusted trial balance. So trial balance, this is the accounting report which gives us the closing balances as of the date for each account head in our chart of account. Then from unadjusted trial balance, you need to go and make adjusting entries. What are adjusting entries? Adjusting entries, if you have any prepaid expenses or you have any unearned revenue, so you need to go and pass adjusting entries, that how much from that prepaid expense you have spent out in this particular period. You need to record that expense. You will give debit to the expense and give credit to the prepaid expense, the asset. So after making all the adjusting entries for the payroll, for the prepaid expenses, for the unearned revenues, for all accrued expenses, you will go and make adjusting entries. After adjusting entries, you will go and you will regenerate adjusted trial balance. In this, all the balances will be revised after passing the adjusting entries. When you have made the adjusted trial balance, you will go and prepare the financial statements. And after making financial statements, you will go and close the books of account. What is the closing of books of accounts? In closing of books of accounts, all the temporary account you will close to the profit and loss summary account, and profit and loss summary account, it will be closed to the retained earnings account. Like this, your books of account will closed. And what are temporary account? All the income and expense accounts are temporary account, and all the assets, liabilities and equity, these are the real accounts. So this will continue, the real accounts will continue their balances throughout the life of the business, but the income and expenses, the temporary accounts, this at each year end it will close. So like this is the complete accounting cycle of any organization. First journal entries, then ledger accounts come, then unadjusted trial balance, then adjusting entries, after that adjusted trial balance, after that financial statements, and then closing books of accounts. So this is the complete accounting cycle of any organization. I hope the knowledge we have discussed in this video will add value to your accounting skills. In our next video, we will learn about accounting applications and accounting softwares. That is also very important topic, and I am sure that after watching that video, you can use any accounting software without any training. Stay connected to my channel by hitting subscribe button. Thank you.